Hey everyone, Russell Gray, co-host of the Real Estate Guys radio show, here for another edition of Boots on the Ground. This time we're going to take a look at commercial lending, alternative lending, and our Boots on the Ground correspondent for that is Billy Brown. Hey, Billy.
Russ, thanks for having me here. It's good to provide another update on what's happening in the world of lending to all the viewers and listeners out there to see, get them insights on what's happening and how they take advantage of this fun, fascinating time.
Yeah. So, just a little bit of the dynamics. Obviously, we're smack dab here in August of 2020 in the middle of this cascading COVID-19 crisis. Started with the health crisis, which locked the economy down, and there's still major chunks of the economy locked down. That triggers what could potentially become a credit market crisis, because when people can't make their payments, credit markets start to fall apart. And so one of the reasons I enjoy speaking with you is because you have your thumb on the pulse of some of that. If they're tightening their lending guidelines, because even though we have low interest rates, the looseness of lending isn't just interest rates, it's underwriting criteria and what hoops you have to jump through and what kind of collateral they will and won't accept. And obviously you're in the alternative space. So just so no investor left behind, just a quick explanation between the difference between, say, conventional or agency money versus what you do.
Yeah, so as agency money, you think of Fannie Freddie for multifamily space. I do more CMBS lending, which is quote alternative. It's not
Commercial mortgage-backed security, stuff that gets
securities.
packaged up and sold to Wall Street investors.
Yeah, and that's mainly where my lending has been for the last 2 years. It has been very attractive. Unfortunately, they did not get bailed out like everyone else did. So their market rates right now and market criteria, which sometimes meant zero, especially when it came out, like they weren't buying anything. There's no bids on this paper whatsoever.
Yeah, they're all waiting for the other shoe to drop, right? I mean, commercial
Yeah.
mortgage-backed securities is going to be loans that are made against office, against retail, and some of these sectors are just in hospitality are in really bad shape. I suppose if they could narrow the field and say we'll only invest in debt on industrial, some of the sectors that are thriving. But what about, residential? A lot of the folks that are watching, in our audience are going to be residential investors. Maybe they have a portfolio they've accumulated. If a husband and wife are really attentive to their borrowing, they can get up to, 20 single family homes with Fannie and Freddie loans, which are basically subsidized loans.
Yeah.
And now they may have some equity if they did that over a period of years. And are you still able to do those kind of portfolio loans and extract equity? Is that still out there? What kind of action are you seeing in the residential space?
Yeah, we're starting to. I mean, there's a big demand for it. The market pricing for that type of a loan is still a little high for it to make sense. Because if you've got 20 loans,
well, I mean, what's high?
Mid sixes right now.
Okay,
so, which is historically is not bad, but when they were low fours, mid fours, 7 or 8 months ago, and now you're quoting, mid sixes. You're like, I'm going to wait to see what happens. Like, well, I'm not sure if it's going to actually get any better.
So you've got borrowers sitting on the fence hoping rates are going to come down for them. Yeah. So, ladies and gentlemen, here's the deal. Interest rates are risk premiums. Yeah. That's what an interest rate is. Think of it like your insurance premium. So if you're a bad driver, if you get in a lot of accidents, if you're not very experienced, if you drive a really expensive car that has a high probability of being stolen or would be very expensive to repair if damaged, you're going to pay more for your insurance. You're going to have a higher rate. Well, you may not be the problem. This is the thing. When these things happen, you're not the problem. The problem is what's going on in the environment. And in the environment right now, commercial mortgage-backed securities are dangerous for investors. And so if they're going to do those deals, they want to make sure they have a good borrower, good collateral, good ratios, good reserves, and they want to get some yield. The other thing is you have to understand that anybody that isn't government subsidized is going to need to make a real market rate, which is going to have to be positive net of inflation. And we already know that the Fed is out there busily trying to create inflation, and we're starting to see it show up in the CPI. So when you look at that, I mean, would you loan somebody money if inflation is running 7%? Would you loan it to them at 5%? Of course not. You wouldn't do it. So the question isn't how much does the money cost? And I would make the argument, having been around a while, I mean, 6%, anything below 7%, I mean, really anything single digit is pretty darn attractive. The key is, what could you do with the proceeds, right? If you leave the equity trapped in the property, it's trapped in the property. It's not doing anything, except maybe, you don't have to make as big a payment. But if you can arbitrage, in other words, if you can borrow at 6 and invest at 12, why wouldn't you want to borrow as much as you could at 6? I mean, that's the way I look at it, because the equity, the market could take the equity away. So, what type of, LTVs, what type of ratios, what type of reserves, and are they even limiting, we'll only look at these kind of deals and not these kind of deals or areas? You seeing any of that?
Well, I mean, my world is basically the single family and multifamily world. I do some office. That's kind of shut off right now. No hospitality at all, obviously. Industrial, good luck finding it because it's in high demand. So focusing back on the single family and the multifamily, it's actually performed well throughout the COVID as of right now. But the lending has come back. They're actually they've gone from 65% leverage to 70% leverage. I've got a lender that will do 75% leverage above $1 million. Reserves, big, no matter where you are, reserves are going to be key. Now, if you're going to do a refinance of anything right now, they're actually going to hold back 6 months of reserves. They're going to escrow for that.
What about seasoning on those reserves? If you have to move some cash around to, make sure your package looks good, how far back do they look in sourcing the cash? Couple months, 60 days. Okay, so that hasn't changed.
Yeah.
Okay.
Yeah. And if you need to bring someone else on board, I can do that as well. It's not that world's not too, they don't really care about. But if you already got money, they're trying to refinance a whole bunch of money, they're going to hold back 6 months of those net proceeds and escrow for 6 months. Sometimes they're taking the first 6 payments, which is nice. Others are like, hey, we're taking the 6 months of payments and reserving it, and you're making payments. So it just really depends on the lender and where we're at. Obviously, those guys are going to be more aggressive with rates because they got more security, knowing that they've got payments coming in and 6 months reserves they're going to hold them on for sometimes 1 to 3 years. Sometimes it's 12 months. Sometimes it's 3 years. So it really depends.
So have these things turned into more? I mean, it's just really more portfolio lending. Are these people holding them? Is there not a market for seeing investors? No, they're flipping them still to Wall Street.
They're flip paper. Yeah, they're flip paper.
Okay.
Only the ones that are holding these are more depository lenders, and even then, they're not really excited about that. Just it ties up too much cash. So most of these guys are selling it off to up the channel.
Okay. So, again, for people that just don't understand the way it works, a mortgage broker at whatever level and is one level, and that's somebody who's kind of the middle person, a guy like Billy. That's what I did when I was in the mortgage business, and you represent the borrower to the lender, and typically the lender is going to be some type of a mortgage banker. And what that is that's somebody that is operating out of their own credit line or maybe out of their own capital, and they loan it, but they're flippers. They flip the paper. So what they do is they create the paper by making you the loan, and they get it to a point, whatever point it is, 1 or 2 months sometimes. And usually that's just the waiting period while they're aggregating other loans until they have a big enough package, and they package them all up, and then they trot them off to Wall Street, where Wall Street investors who are income investors purchase them. And they're purchasing them for the production of income. And the reason they do that is because the other really fairly conservative places where you could go to borrow money, corporate debt, high grade corporate debt and government debt are just paying no yields whatsoever. No. So, in their thirst for yield, I mean, I just did a newsletter 2 days ago, Billy, maybe you saw it. And I was talking about how the appetite for junk bonds. I mean, these people are so desperate for income. They're going and they're buying poorly rated, poorly capitalized businesses that are struggling. They're buying their debt and fixing the rate for less than 3%. Mm-hmm. Less than 3%. And my argument there is, when those people wake up and realize that they can go into real estate, they just have to be smart about the kind of real estate. And personally, I think that residential real estate is going to be one of the areas of real estate that end up holding up very well, because people may not go to stores, they may not go to restaurants, they might not be able to go to the gym, they might not be able to go to the mall or want to go to the mall, they might not even go to the office, but they're going to sleep in, under a roof at the end of the night, yeah. Right? I mean, they're going to stay at home, and a lot of people are going to actually want to improve and expand their homes because now they've got home offices and they're homeschooling and they got home gyms. So I think residential is going to be one of the areas that actually is going to attract, both investor interest, but also lender interest. I mean, are you seeing anything? I know we're still very, very early innings right now, but are you seeing anything like that at all, Billy?
Yeah, I mean, I actually read an article this morning, posted from one of my mortgage guys that actually the Fannie Mae Freddie Mac actually raised rates on refinances. And they're like, well, why would you do that? They just raised it like 0.5% for a refinance for somebody. And they're like, well, it's because they can.
Yeah.
There's enough profit there, and they're actually trying to take it back, and they're trying to make their, what before things flip. So
well, you've got inflation too. I mean, these rates all have to be adjusted. They're not nominal, which means numbers. They're not just numbers. They have to be real, which is net of inflation. So if I have a 5% note in a 3% inflation world, then my real rate is only 2.
Mm-hmm.
And so, you're going to start to see that. That's what inflation does. And in order to try to suppress those interest rates, this is the vicious cycle the Fed catches themselves in. Peter Schiff talks about this all the time. Because in order for them to try to suppress those interest rates, what does the Fed have to do? Print money and purchase bonds. What does that cause? Inflation. And right now, they're not doing anything to try to prevent inflation, because if they did, they would have to raise rates, which would collapse the bond market. So rates are going to start to raise anyway, and this is kind of the death spiral. Now, that may sound scary, but it makes the argument, hey, if you have an opportunity to grab loans at today's rates, well, you still have equity there and you can get liquid. Personally, and I'm not giving you investment advice, I'm just saying personally, grab all you can get. And then get ready, because when those credit markets unravel like they did in 2008, and this ought to be worse, then all that purchasing power leaves the market. And if you're flush with cash, now you go bargain shopping. And if you're out of position, you won't be able to do it. So now's the time, in my opinion. It's just my opinion, right?
We're starting to
worth
see
what
that
you
already.
paid for it.
Yeah, exactly. We're starting to see that already. There's some wrinkles in the market. There's caution. I mean, you got obviously all this. You got election year, politics aside. Lenders pay attention to politics, and whoever's in the office does make a impact on laws and all that. So they're being a little more conservative. But right now, I'm the same thing. If you've got equity there, we know equity disappears just like that. Interest rates go up, equity disappears, and lending goes away. You've got left with nothing, and you've got lots of deals on the table and nothing there. So I tell people always ask me, well, I'm gonna wait until actually I see something before I refinance. Going.
Yeah, well, my question would be, so if 6.5 is too high, what would be the right price? The right price would be 5. Okay, so you're talking about a 1.5% difference. I would chalk that up as an insurance premium to be liquid and protect my equity. And I think that you could easily make that 1.5% back and a whole bunch more by being liquid in a market when properties are selling for 20, 30, 40% off.
They are. And there's other bailout things you can go do with businesses and CMBS rescues. There's so many opportunities that happen and open up to you when you are liquid. Now, go back to CM's world, the portfolio thing, they're limiting to 70% on the leverage. People are like, well, we're seeing 80% 7 months ago. It's like, that's a whole other world. That was Earth before. This is reality. One of the great things I actually like about it is there is appetite now, even at that leverage point, for a 10-year fixed interest only. So if you're going to, 30-year AM anyway, you're not paying down principal that much. So why the heck do you even care about amortizing this thing? Interest only saves you a bunch of cash as far as your cash flow. So you can get the best of both worlds.
And the interest is deductible. And of course, who knows, in a new tax regime that could change. I wouldn't bet the farm on that. But the current environment it's true. Yeah. So, that's also something to look at. But I mean, you have to ask yourself, really, it's just the cost of capital. And you have to ask yourself, if you're going to spend the money, well, don't do that, right? Don't borrow against equity and consume it. Don't live on it, even if you're having hard times. I don't think that's the right answer. Force yourself to go figure out how to solve your revenue problem. But I mean, if you've got enough income to pay your bills and you've got idle equity sitting in your properties, and you have the opportunity to go grab some of it and get liquid, you can always put it back. I mean, it might cost you a little bit. You can say, okay, well, I waited 2 years and no bargains came. I'm just going to put it back. You can do that. I mean, just, make sure you have a loan that doesn't have a prepayment penalty. Or you might be willing to take one and you get a little bit of extra, lower interest or lower points, when you start taking risk, because you're pricing. I mean, there's rates, right, Billy? And then there's the other parts, right? And all of that is a little bit negotiable, not highly negotiable, again, because guys that are flipping paper are underwriting to third-party standards. They've been handed a list that says, hey, we'll buy paper that fits in this box. But it is a box, right? It might be a small box, but there's some wiggle room even inside the box.
There's a little bit there, yeah.
Yeah. And so you just have to understand that, when you take risk, you say, oh, I want a 30-year fixed. Okay, you just put risk on them. You're going to pay more for that. You say, well, I'll do adjustable. Now you've taken risk away. You're going to get a benefit for that. Of course, I wouldn't take that risk in today's environment, but that's an example.
Yeah, the fixed interest only for a long period of time makes you feel pretty good. You've got a long runway there for the cycle happen, and you got cash there to go do it. Hey, if you're sitting on cash and you don't know where to put it, obviously Syndication Mentoring Club, you meet a lot of people there to put your cash to work and make a pretty good spread. There's going to be opportunities, and it's amazing. I actually just heard a client of mine, she just got his loan closed. It took about a year because it was a little weird deal. It wasn't single family like that. It was actually mobile home park. We refinanced, and he's like, he called me back, thanked me, going, all right, man, I've got money to lend. Like if you got investors that have deals and or need some partners and all that, I've got
there's been trillions printed, and there's a thirst for yield, and people are like, okay, I want good yield, but I want a good counterparty. Well, what's a good counterparty? Yeah. Well, somebody that is borrowing against, an asset, and especially if it's an asset that has a pretty good track record or is well positioned to survive what's coming. Yeah. So yeah, I think there's a lot of opportunity in this space. Okay, so Billy, I want to wrap this thing up because we could talk for hours and it's fun. I mean, especially because this is kind of my wheelhouse. Yeah. But what do you think? In August of 2020, we're sitting here and kind of the mood of the market. What do you think people need to know about the alternative residential lending space, maybe that we haven't already addressed?
Reserves are going to be key. Get your credit score up. Make sure you got high credit scores, or it's a tighter box. If you have equity, I like equity in the table. Now's the time to look at it. Worst case is we just say it's not the right time for you as far as your positioning, but at least make that inquiry to be able to know, you get prepared. Because there's two things going to happen. It's going to be a bumpy, probably next 3 months or so, especially post-election or closer to election. And then the fun's going to happen because there's going to be a lot of opportunities going to be available to you. Those that are prepared, both financially with their financial self as well as liquidity, are going to just, I hate to say this, mop up, but there's going to be a lot of deals that are going to change lives. Yeah,
I think probably the number one mistake that I see rookie investors make, or even a lot of people, is they don't understand that your credit profile is something you should manage the way you would manage a property. And you have advisors like yourself. I used to do this, and you help people understand how to organize their finances. Because the thing is, the time to think about your profile and how you show up to a lender and what they're going to be looking for isn't when you're in escrow, isn't when you've made an offer and there's a 30-day or a 60-day or whatever the escrow period time clock ticking over your head is. And in a competitive environment, when you show up already really well qualified, with some type of a letter of credit or some type of a pre-qualification, or however it's done these days, where, a credible lender is saying, yes, I've evaluated this person, they're credit worthy, they're pre-approved. As long as the property and the income is there, this person's going to get this loan. Then that's not quite as good as being a cash buyer, but it's better than just being a guy that hasn't even talked to your loan person and you're out there and you get yourself in a deal. So I know that real estate investors all get enamored of the property and the deal, and they really don't think about the financing. It's just a pain. But as a strategic real estate investor, really, you're using the real estate just as a vehicle to control the cash flow and the debt. And it's really the debt over time that makes you money. And we don't have time to delve into that, but contemplate that in your spare time, because that's really the magic. The magic of real estate and how equity happens, if you will, is through debt. And when you have debt on your balance sheet that is being serviced by somebody else and providing you tax breaks, you have the wind at your back, because the Fed is always got the back of people who are in debt.
Yep.
I mean, starting with the U.S. government first and foremost.
Exactly. The other thing I was going to throw out real quick is for people to know is not only your credit profile, but also they're going to look at you from versus the Fannie Freddie single family stuff. subsidizing this or looking as a business owner. So you need to come to the table looking like a business owner that has experience managing and running the properties, and show up with your team, not just yourself. You got to present yourself as a team player in the rest of your team. And that's what lenders are really lending on right now, is that experience, because as we just saw, there's trouble. We went through a lot of trouble. How do you captain the ship? It makes a lot of sense. So,
okay. So that, I mean, in syndication, of course, we talk about the importance and how you build your brand. So anything you lack, I mean, it's like, you know, the old thing is, well, how do I get experience if nobody will give me a chance? Well, you align with somebody who's experienced, and then you get credit for their experience, and then you do a deal with them. And then when the deal's done, now you have something on your resume that counts as your experience. And the other thing is, if you do decide to go down the path of raising money from other people to do bigger deals, make sure that you have a great advisory team, right? You don't want to go practice your craft on other people's money. You know, you want to make sure you have mentors there available to call on, advisors, you know, technical advisors on the finance, on the insurance, on the operations, on the legal. And, you know, you can pay for those people. Sometimes you can create strategic alliances with those people. Sometimes people like Billy will do that for you simply because they want to earn your business. But, you know, things you can be doing right now, even if you're not in the market for a deal, even if you're kind of taking a wait and see. I'm not a big fan of wait and see. I always say think and do is better than wait and see. We know that there's going to be opportunity. That's a given. The question is are you going to be in position to take advantage of it? You can start working on that today. Okay, Billy. So I think we'll call that a wrap. We'll do it again next month. If something, you know, if there's a mega shift that happens in the world of your lending world, and you need, you want to help us let our viewers know, let me know, and we'll put you back on.
Sounds good.
Okay, Billy.
Great talking to you. Great to see you again.
All right. Thank you so much.